But meanwhile, another big announcement today was a boost to digital payments. The RBI today allowed linking of credit cards with UPI. Currently, only transactions linked to savings or current accounts on debit cards are facilitated on UPI. Harsh is joining us to explain how this will change things for you.
Well, the RBI has enabled payments from credit cards to be undertaken on the UPI platform. And what does this mean technically for the users? Let's try and break this down a little bit. UPI is the most inclusive mode of digital payments currently in the country. It has 26 crore users, 5 crore merchants, and processes nearly 600 crore transactions. That happened in the month of May. And the total value of transactions to 10 lakh crore plus. So quite voluminous and quite wide scale. But UPI currently is linked only to your savings or current account and thereby linked to your debit cards. Now, what the RBI has enabled or is looking to enable is the linking of the UPI with credit cards. What it will mean is that the RuPay card or the RuPay credit card will be the first card to be linked with the UPI platform. Of course, this provides more avenues and more convenience for customers. There are more options for customers to pay through the UPI platform. You don't need to go in and swipe your cards. What it will mean is you can just scan your QR code at the merchant to make sure or to enable a credit card transaction to be undertaken through UPI. So, of course, this is initially only for RuPay cards, but slowly the ambit will be widened for all card providers.
All right, quick COVID check. In the last 24 hours, India has reported 5,233 cases. The country recorded over 5,000 cases for the first time in the past 93 days. But remember, this is the number from this morning, so it hasn't taken into account the Maharashtra figures which have come later in the evening. So you see a bumped up number tomorrow because Maharashtra this evening has reported 2,701 new cases in the last 24 hours. And out of that 2,700 odd, just Mumbai has 1,765 cases. So the cases are rising pretty quickly. The DGCA has now, in response, stepped up vigil. The aviation regulator has once again made masks mandatory throughout the flight and even on airports. Violators will in fact be put on a no-fly list. My colleague Samir filed this report earlier today.
Seeking a sudden surge in the COVID cases in few states, the aviation regulator DGCA has reissued the instructions for airlines as well as for the airports to maintain proper COVID safety protocols at both the places when it is there in flight or at the airport. For example, when it comes to airlines, the DGCA has laid down that the cabin crew has to make regular announcements in the flights related to the COVID safety protocols. It has to be ensured by all the passengers, those who are in flight. Especially the face mask has to be put on by the passenger. And if any passenger has not put up this face mask, especially after repeated announcement, then that passenger may even be put under the unruly passenger category and may even be deboarded from the flight if it is there at the terminal. Along with this, the extra face mask has to be carried by the airline and it can be provided to the passenger if requested. Along with this, for the airport, it has been laid down by the regulator that if any passenger is not wearing a face mask, he or she will not be allowed to enter the airport. Regular COVID safety protocol announcements has to be made inside the airport at the terminal, and if any passenger is not following those protocols, then the punishment or the penalty could be imposed upon that particular passenger. So clearly these instructions have been issued by the regulator, and the primary purpose is that the growth which is there in the aviation sector, the number of flying passengers that is continuously increasing, that should not be impacted because of the rise in COVID cases in few states.
There was no great surprise when the RBI announced a 50 basis points rate hike today. It's clearly a continued effort to tame inflation. The Reserve Bank of India has hiked the repo rate by 50 basis points and it now stands at 4.90%. This rate hike comes just a month after the RBI hiked the key policy rate by 40 basis points in an off-cycle meet in May. The MPC voted unanimously to change the stance, and this is important. Basis points in an off-cycle meet in May. The MPC voted unanimously to change the stance, and this is important. The stance has been changed to withdrawal of accommodation from the accommodative stance it had maintained through the pandemic. Among the key highlights from the policy review was the acceptance that inflation will remain much higher than was previously thought for a longer period of time. The central bank now anticipates that CPI will stand at 6.7% in FY23. That's a percentage point higher than the previous estimate. The cool-off in inflation is expected to take place only towards the end of the financial year, with prices rising by over 6% till December. FY23 GDP growth is seen at 7.2%, and this estimate has not been changed. The RBI Governor Shaktikanta Das also proposed linking of credit cards to the UPI platform today. So some very interesting announcements there, but what we're going to focus on today is going to be what this says about the economy and what is the kind of impact we will see of consistently high interest rates. To speak on this, I'm joined now by Aditi Nayar, Chief Economist at ICRA, Rahul Bajoria, Chief India Economist at Barclays, and Madan Sabnavis, Chief Economist at Bank of Baroda. Welcome to all of you, and great to speak with you on the India development debate. Now, I started by saying there was no big surprise, and let me begin with you, Aditi, on your commentary. But do you think that this 6.7% of CPI for FY23 is also on the conservative side?
Thanks, Tamanna. First of all, we had penciled in a rate hike of 40 basis points today because we thought it would be at par with the unexpected hike that we got last month. So it's slightly more front-loaded than what we were expecting. And with the governor's reminder that the repo rate still remains below the pre-pandemic level, I mean, clearly further rate hikes are on the cards, and we're expecting 35 basis points in the next meeting and 25 basis points in the September meeting to get us to 550 by the end of September 2022. Now, in terms of the inflation revision, see, our view was that with the further increase in crude oil prices now that China is opening up and there's a new source of demand which has come back online, we thought that we are going to be in for a period where crude oil prices are going to range between $100 and $120 per barrel for the most part. So we've given up our earlier expectation that if things cool down, crude could ease down to 90. We no longer expect that to be the case, and we expect the base to be 100 going ahead. And with that, we saw upside risks to our 6.5% CPI inflation forecast. So 6.7% is a little bit higher than that. I must say that the forecast of 7.5% for this quarter and 7.4% for the next quarter does seem to be a little bit higher than what I was penciling in. So I'll be, it'll be interesting to see what kind of a number we get next week for the CPI and really how far away it is from our expectation versus the expectation.
Coming in, and you're right, next week will be the CPI print for the month of May, so we'll have to see if that's another shocker. But Madan, directionally now, is it clear that we have entered a longish phase of higher interest rates, and this is not the end of it? We've seen 90 bips, say, in the last couple of months, and there is more to come. Would that be a fair assessment?
Yes, I think that would be a fair assessment, because I think it has been indicated by the RBI governor too that the pre-pandemic situation of 5.15% coming down to 4% was exceptional, and we would definitely have to move towards it. So moving to 5.15% was given. Now the question is that with the high inflation numbers which have been projected, it's more likely that we could be ending up at a higher level at maybe 5.5, 5.6, because we are looking at something like 50 to 75 basis points hike in the repo rate during the rest of the year. Of course, everything would be data driven. I think that's what all the economists say, that it will be based on how the inflation numbers turn out to be. And I think the number of around 6.7% is largely in line with what we have around 6.5%. And therefore, I think it would be fair enough to say that there would be further increases in interest rates. And as far as borrowers are concerned, they will have to be prepared to pay more. I think the days of easy money where capital was being mispriced are over. Now they're going to be priced in a better manner. And I think as deposit holders, savers will be better off.
Will savers be better off? I'm going to come back to you on that, because your FD rates have not gone up in any great hurry. Rahul Bajoria, I know I'm waiting for your overall commentary on the policy, but since Madan has sort of made this comment, just your quick take on that. Are savers truly better off No one knows if their incomes this year is going to beat inflation at 6.7%. People can only hope. Your returns from FDs have not gone up fantastically. Mutual funds performance have been so-so. Markets are not really promising much. Is it really a good time for savers?
No, you're right. I mean, in terms of financial savings, I mean, there's certainly been a bit of a negative hit, and some of the wealth effects are also likely to be felt, which were quite positive for the last couple of years. I mean, that's going to turn a bit more negative, at least, so far, given the performance of both the equity markets and what's happened with fixed income products. But then I think one of the key points here is that, monetary policy always works with a lag. So, we have already actually seen a few banks, move up their deposit rates, and while lending rates are given that they are now externally benchmarked, they are moving up much faster. We will see the demand for deposits also increase, and competition for deposits increase as liquidity tightens in the banking system, which is happening in a concurrent manner. I think more than that, one of the points I wanted to make was that there's today's policy. I think while the decision was along predictable lines, what I think the messaging and the numbers have done is that it have increased the predictability of policy decisions going forward, which was kind of unanchored in the last couple of months, given the sharp moves we had seen from the RBI side. So I think given where the forecasts are at the moment, I would agree with what Aditi said at the beginning, that there seems to be some wiggle room for the RBI, and the expectations that they are anywhere behind the curve, I think now should be completely put in a box and put away. I think they have played a fair amount of catch up, and from here on it will be a very data driven view as far as the monetary policy outlook is concerned.
What about the view of whether these hikes are going to impact growth? That debate is still very much up in the air. Aditi, do you want to weigh in on that? Predictability can be a good thing, but when we know that interest rates are going to be predictably inching upwards, do you think it will have an impact on growth estimates?
So, Tamanna, in terms of transmission, I think we're in for a period of varied transmission now going ahead. So on the bank side, we expect that transmission is going to be quite swift. There is a predictability, there is an expectation that rate hikes will continue. The systemic liquidity surplus has already come down quite sharply in the last couple of months. And in the up cycle, we do think that lending rates as well as deposit rates will go up fairly quickly. Despite that, we do think that credit growth is going to be somewhere in the range of 10% this year. Because firstly, we do think there will be a back-ended pickup in private sector capacity expansion. Also, working capital requirement of the manufacturing sector will be on the higher side. And maybe there will be some amount of shift from the bond market to bank lending. So between these three reasons, we think that a credit growth of 10% is likely this year. On the other hand, that statement made a comeback about the central bank focusing on the orderly completion of the government borrowing program. So of course we're waiting to see what that means. What is the measure that's going to be introduced, whether the amounts backing that up are meaningful enough. But it is likely that at least in the government security market, long-term yields will not go up now as much as what we were expecting earlier, although the short-term rates will go up. So I think there's going to be a differential transmission that will be happening going ahead. On the growth side, you see, my firm belief is that the items on which prices have gone up very quickly are items that immediately hit the household budget, whether it's fuel, edible oil, vegetables. People immediately get impacted by that. So there is no question of demand not being hit for a certain category of consumers. There will, however, be other categories of consumers where the income certainty is far better this year as compared to what it's been in the last 2 years. And these are the households that are dependent on the services sectors, which are making a comeback now. And in any case, so the growth revival itself is going to be very uneven. We expect that the services sector is going to do significantly better than the manufacturing sector as well as the agricultural sector. So I would say that in any case, the underlying growth momentum is going to remain uneven this year. And I agree, all borrowers should be willing, ready to pay higher prices, higher interest rates, including perhaps the government.
Madan, you want to come in on that point, and also, your elaboration on the point of whether this is truly good for savers. What does it mean for growth? What does it mean for demand?
Okay, so if you look at the basics of theory, it says that when you increase interest rates, you're supposed to get in the way of excess demand forces. So if you're looking at what's happening in the West, when you're saying that the US economy is overheating, and one of the signs is that unemployment rates have come down drastically. So therefore, you're increasing interest rates in order to curb the economic growth. So therefore, theoretically, it has to affect growth. Now, if you look at the Indian condition, we are definitely not in any way close to what's happening in the US. We are just about getting out from the lockdown effects, and therefore we are sort of recovering. So the way I look at how interest rates are going to work is that it's going to work at the margin. The excess demand forces are definitely going to be affected. Now, what do we talk of these excess demand forces? As a person who's buying a home, am I not going to buy my home merely because interest rates are rising? Because I know very well that this interest rate cycle is going to last maybe for 2-3 years. It could be shorter or longer depending upon how inflation behaves. The answer is no. I will continue to buy the home if I find that the price is right for me. Second, if I'm a large corporate, will higher interest rates actually come in the way of my investment, provided I see demand? So here I would juxtapose this with what the RBI said about capacity utilization rates improving, and it also expects capacity utilizations to improve further. Of course, this is not going to be broad-based, it will be sector-specific. So these particular sectors are going to continue to invest as long as you see demand. However, companies which are maybe your FMCG companies, for example, or your consumer durables, where we haven't yet seen a revival in demand, they are not going to go in for higher investment because of higher interest rates. So I think that's how I think interest rates are going to work in terms of affecting growth. So some sectors will grow, some sectors will not. And definitely if I'm an SME, I'm going to get affected because my working capital requirements are going to be normal. So I'm going to pay a higher cost for it, and my ability to invest is going to come down. So it's going to be kind of a mixed baggage when you're talking of growth. Now, in terms of savings, what I was referring to is once I enter the cycle of interest rates rising, it's going to help the savers. It is true that deposit rates will rise with a lag, and they will definitely not rise to the same extent of what's happening to the repo rate. But instead of getting a 5% return on deposits, maybe if the repo rate goes up by, say, 200 basis points, I may get maybe 50 to 75 basis points increase. I've seen approximately it's a 50% reaction to what happens to the repo rate. So savings in the long term or the medium term will definitely benefit.
Let me just play out for you, and I want to go into a little bit more detail on the growth prospects. Let me just play out for you what the chief economic advisor today said on the question and issue of growth.
But I also would implore you to look beyond the current concerns over inflation, prices of oil, food, fertilizer, central bank interest rates, etc. Because India has emerged out of the previous decade with its financial system well repaired, improved, and with the balance sheet strength, as well as in the corporate sector, not just in the banking and financial sector. And some of the structural reforms that the government under the Prime Minister, Sri Narendra Modi, ably assisted by the Honorable Union Finance Minister in the last several years, reforms such as the Goods and Services Tax, Insolvency and Bankruptcy Code, etc., might have been temporarily overshadowed by external developments such as the pandemic and now the geopolitical conflict. However, once these clouds recede, they will begin to manifest their benefits and advantages in enhancing India's potential growth.
Just your thoughts on that. Let me start with you, Aditi, that we have to keep in mind the broad sort of strength of the Indian economy and whether that will kick in at this point. So the factors going ahead, if we have a decent monsoon, if we don't have a resurgence in COVID-19 cases, and the Mumbai figures from this evening are alarming. We're over nearly 1,700 cases today as well, but no deaths. So it's looking like it's manageable. We maybe will not see more lockdowns or restrictions, etc. If all of these factors fall in place, does the outlook then change dramatically?
See, in the immediate term, I think what we're going to get is a resurgence in the services sector. People want to go out and do the things that the pandemic has stopped them from doing in the last 2 years. So I firmly believe that as long as the pandemic remains under control, I do think that the services sector is going to do quite well in the current year. The fallout of that is that people are going to spend less on things like consumer durables, and what people purchase within consumer non-durables may also shift. last couple of years, we bought pandemic necessities. Now we might buy other things. So even within the manufacturing sector, there will be a lot of shifts. There'll be sort of gainers and there will be laggards this year. For the lower to mid-income groups, I think many of them are going to face a very real budget constraint, and anything that's a non-essential purchase is going to be weighed very carefully before a decision is taken to go ahead and buy it or not. On the agricultural side, I have some reservations in terms of how much a good monsoon is going to be able to push agricultural growth in a scenario where perhaps the availability of labor in the rural areas will be less than what it's been in the last year. And the fertilizer situation isn't that great either. So I would imagine that this is going to be a year of modest agricultural growth. And because of the heat wave and its impact on the wheat output, there will be categories of farmers again whose demand may not be great until the next harvest kicks in. So I also don't think that rural demand or farm demand is going to be evenly robust across the country. There's going to again be pockets of demand compression, particularly for those farmers where the wheat output loss is going to really pinch them. So in the immediate term, I think it's going to be a very uneven year as far as growth is concerned. I do caution against over-tightening in the current situation. The original triggers of this high inflation episode are global in nature. Of course, we have added domestic factors as well, particularly part of the food inflation conundrum is domestically driven. All of it is not, the global supply side issues. But I think we need to be cautious in terms of how much rates need to go up.
Right.
Increase rates to focus on inflationary expectations is fine, but we shouldn't really be looking at a growth sacrifice going ahead.
Just your take on that, Madan, on some of the points that the CEA also made, that if most of the supply shocks are external, can we hope that some of these factors will also dissipate?
They will dissipate, but I think when we're talking of 7.2% growth, I think I would say that's the best possible case. There's always a downside, because I think with high inflation, consumption could get affected. So therefore, I think we have to be cautious on that. I don't think 7.2 will become 7.5. Can it go down to 6.9? Possibly, yes. And lastly, what I think we should also keep in mind that we normally tend to overstate this agricultural piece. Where for the last 4 or 5 years, we say we've had normal monsoons, but our GDP growth has been quite abysmal. So we have not seen that kind of growth. So relying too much on verbs by saying that agriculture is going to drive the economy never really works in that way. So therefore, I would be cautiously and guarded by saying 7.2 is best possible scenario. It could be a downside, but probably not an upside based on the conditions as of today.
Rahul, your growth outlook?
Yes, so we are slightly below RBI's forecast. We are at 7%, but I would completely agree with Madan that, there is 7.2 looks like the best case outcome. And perhaps, when you are hiking and you're hiking aggressively, you don't want to be giving a signal that, growth is slowing down in a concurrent way. So perhaps, the bias is to look at it downside. I think just to interpret what the chief economic advisor also said, there is an element of, I think the starting positions for India have improved, at least from a balance sheet perspective. Whether we look at the external balance sheet, we look at the financial balance sheet, whether we look at household balance sheets, they've all kind of undergone, at least at a macro level, some amount of repair work in the last few years. And so perhaps there is some room for resiliency, but then the adjustments of external sector shocks, which are kind of feeding through the system have to be taken. I think ultimately it will come down to what are the variables which are allowed to adjust. And I think this is where the balance between fiscal, monetary and external policy will kind of kick in, right? And that is where I think, the challenge will be for India to navigate over the next 3 to 6 months.
Yep, absolutely. It's going to be a challenge in the short to medium term. These concerns about inflation are not going to go away in a hurry. And the RBI has made it very, very clear today that they will be on this, like they were during the pandemic when they had to, lower interest rates and have a growth orientation, a more accommodative stance. If the reverse is required today, it will be done. Thank you so much to all of you for joining us on the discussion today.